Welcome to another video of Excel Academy. In this video, we will continue from where we had left in the previous video in the series Answers to the June 2017 Company Accounts paper of Executive. This, as you can notice, is a problem relating to the underwriting of shares. The company has issued 30 lakh shares, out of which 18 lakh shares are issued to the public, as the remaining 12 lakh shares are issued to the promoters themselves. The underwriters A, B and C have underwritten the entire issue in the ratio of 2:3:4. That is, A will take up 4 lakhs, B 6 lakhs and C will take up 8 lakh shares. Then there is firm underwriting as well, wherein A will definitely subscribe for 60,000 shares, B for 50,000 shares and C for 70,000 shares. As we know, firm underwriting shares means they will have to subscribe to those shares irrespective of subscription by the public. That is, whether or not the company receives the minimum subscription, the underwriters will definitely subscribe for these shares, called the firm underwriting shares. It is also mentioned in the problem that the company received marked applications of 3 lakhs from A, 3.5 lakhs from B and 5 lakhs from C. That is, those underwriters have already subscribed for these shares. Marked applications are nothing but applications which contains the stamp of the underwriter. Now the total applications received are 15 lakhs 38,000, which also includes the marked applications. That means the company has not received total 18 lakh applications from the public. It has received less than that, and which now will be filled in by the underwriters according to their liability ratio, which is 2:3:4. Here we can notice that the total shares issued is 30 lakhs and issued to public is only 18 and 12 is issued to promoters. From the table, we can now see that total of marked applications comes to 11.5 lakhs. But we know from the problem that the total applications received is 15 lakhs 38,000. Out of which, if we deduct the 11.5 marked applications from the underwriters, we will get the shares subscribed by public, or we can also call it as unmarked applications. Therefore, the amount of shares received from public in this case is 3 lakh 88,000. Out of 15 lakhs 38,000 applications received by the company, 3 lakh 88,000 is the unmarked applications, or the applications received by public in general. But we should not forget that there is something known as firm underwriting as well. The total of all the three underwriters' firm underwriting comes to 1 lakh 80,000. We know that the shares offered to public is 18 lakhs, out of which we have now received marked plus unmarked together, that is 15 lakhs 38,000 applications. And we also know that the underwriters have promised firm underwriting, which comes to 1 lakh 80,000 together. That is all the three underwriters put together. So 15 lakh 38 plus 180, which comes to 17 lakhs 18,000. That means we are now short of only 82,000 shares. This 82,000 shares will be filled in by the underwriters in their gross liability ratio. Here we will see how to calculate how many shares each underwriter should subscribe to. It should be noted that in this problem, we are treating the firm underwriting shares as marked application. The problem can also be solved by treating the firm underwriting shares as unmarked applications. Students should note that they should use one of these methods to solve the problem. Let's start by noting down the gross liability of all the three underwriters, A, B and C. That is 18 lakhs divided in the ratio of 2:3:4. By dividing that, we get 4 lakhs for A, 6 lakhs for B and 8 lakhs for C. We know that the underwriters have already applied for few shares, that is by way of marked applications. So we will deduct them from gross liability. After this, what we will do is we will deduct the firm underwriting shares, that is those shares which the underwriters will anyway subscribe to. As the purpose of this solution is to calculate the liability of underwriters, we have to eliminate all those shares which have already been subscribed. We know from the previous working that the public have subscribed to 3 lakh 88,000 shares, which will be deducted from the underwriter's gross liability in their ratio itself. That is, we will divide 3 lakh 88 in the ratio of 2:3:4 among A, B and C. After doing so, now we get a balance of rupees minus 46,222 in case of A, rupees 70,667 in case of B and rupees 57,555 in case of C. That is, in case of A, the underwriter has already subscribed for more shares than their quota of liability, excluding of course the firm underwriting shares. Therefore, those excess shares subscribed by A can now be apportioned between B and C in their ratio. Now we have got liability of underwriters other than the firm underwriting shares. So for A it is nil because there is already some excess subscription. For B it is 50,858 and for C it is 31,142. So therefore B and C will subscribe for those number of shares which together will come to 82,000, which was the shortfall. But if we add the firm underwriting to this, we will get the total liability of each of the underwriters. So by adding firm underwriting share, now the liability stands at 60,000 for A, 1,08,58 for B and 1,01,142 for C. If you have any doubts regarding this problem, please drop a comment below. And if you haven't already subscribed to our channel Excel Academy, please do subscribe and like this video. Thank you.